Yesterday, the stock market plunged by 900 points. That was a huge drop, and it got a lot of people worried. When President Trump won the election, many investors cheered. They believed his promises about cutting taxes, boosting growth, and cutting red tape. But they also chose to ignore some of the possible downsides, like trade wars and stricter immigration rules. Now, the downsides are coming into focus. Investors are anxious, and they've forgotten about some of the good things they once expected. So the big question is, has this sell-off gone too far, or is it a chance to buy at a discount? Let's break it all down. First, look at cryptocurrencies. Bitcoin, the biggest crypto, once rallied to record highs. Then it tumbled by about 75% from its peak. After that fall, it found support and bounced back to around 80% of its previous top. Ethereum, the second largest crypto, dropped to around $1,878 before it recovered some ground. XRP, another major token, fell to about 209 cents before it climbed back. Crypto markets often follow big swings in stocks. When investors grow nervous about the economy, they sell riskier assets like Bitcoin. Then, when confidence returns, they buy again. These big swings can be scary, but they also offer chances to buy if you believe in the long-term story of digital currencies. Next up is Tesla. Since Trump's election, Tesla's market value ballooned by roughly $700 billion. Elon Musk's public profile and political comments fueled a lot of excitement. But recently, Tesla's stock dropped by about 4.6% in one day. Over the past month, shares are down about 28%, and since the start of the year, they've lost around 32%. Adam Sarin, founder of 50 Park Investments, told Bloomberg that betting on Musk's political influence to push Tesla higher hasn't worked out yet. Investors piled in expecting a Trump bump for Musk, but those gains have faded. Now, cooler heads are prevailing, and many are taking profits or stepping aside until things calm down. When markets move, it's a mix of hard data and expectations. Facts include earnings reports, unemployment numbers, and actual money flowing into assets like Bitcoin. For example, if a big company reports strong profits, that fact can lift its stock. If jobless claims rise more than expected, that fact can send stocks down. Then there is sentiment, which is how people feel about the future. Sentiment can be driven by speeches, headlines, or even tweets. Right now, consumer sentiment is fragile. Since November, surveys show that people are worried. Credit card balances have climbed to $1.3 trillion, and buy now, pay later loans are seeing more missed payments. When consumers max out their cards, they may cut back on spending. Less spending means lower sales for companies, which can hurt profits and stock prices. Trade policy has become a big driver of sentiment too. Early on, some of the tariffs were small or targeted, but now we are seeing the full impact. Canada imposed tariffs on certain goods from China, and China slapped a 100% tariff on some Canadian products in return. That tit-for-tat shows how uneven these fights can be. China can hit back hard because its economy is so big. Smaller countries may struggle to respond at the same scale. These tariff battles create uncertainty for companies that rely on global supply chains. When firms don't know how much they will pay for parts or materials, they may delay investments or hiring. Investors also are pulling money out of the so-called Magnificent Seven tech stocks. These are big names like Nvidia, Apple, Microsoft, Amazon, Google, Meta, and Tesla. In 2023, these stocks led the market higher, and many people piled into ETFs focused on them. Now, some of that money is coming out and rotating into other sectors. That shift reflects changing risk appetite. When sentiment is strong, people chase the hottest names. When sentiment cools, they look for safer or cheaper alternatives. Interest rate expectations have shifted too. A recent survey of Federal Reserve governors showed a 50-50 chance of a rate cut in May. Just a couple of weeks ago, Fed Chair Jerome Powell said rates would probably stay steady for a while. Now, markets are pricing in a possible cut. Why? Because investors expect weak economic news in mid-April, when first quarter reports start rolling in. If companies miss earnings or lay off workers, the Fed may decide to ease policy. Lower rates can boost stocks in the short run, but they also signal that the economy is struggling. Yesterday, a simple interview with Donald Trump rattled markets. He said he did not rule out a recession. Those few words were enough to send investors scrambling. On the same day, Howard Lutnick, head of Cantor Fitzgerald, said he does not expect a recession at all. This clash of views highlights the uncertainty we face. A recession is when economic activity shrinks for at least 2 quarters in a row. But sentiment can change quickly based on what leaders say. If people hear that a recession might come, they may cut spending or delay hiring, which can actually help bring on a recession. That's the power of words in financial markets. But there is a negotiation lesson in all of this. Trump's style, as he wrote in The Art of the Deal, stresses leverage, patience, and the willingness to walk away. He argues that if you want true reciprocal tariffs that match those imposed on us, you have to be willing to accept short-term pain. Prices might go up, and markets might fall before the other side gives in. That pain is the price of leverage. Job cut data adds another layer of worry. In February, U.S. companies announced plans to cut about 172,000 jobs. That was the highest total for that month since July 2020, when the pandemic first hit. Challenger, Gray & Christmas reported that federal government layoffs alone accounted for roughly 62,000 of those cuts, a huge jump from last year. While last year's numbers were tiny, the percentage increase is striking. These are real people losing paychecks, which can reduce consumer spending. If spending drops, companies may see lower sales and profits. That in turn can pressure stocks and lead the Fed to cut rates. If consumer spending slows and job cuts continue, unemployment could rise. Higher unemployment and lower growth often push central banks to lower interest rates. But rate cuts usually come after a slowdown, not before. So the risk of a recession is real if these trends persist. Markets hate uncertainty, and right now we have plenty of it. We talk about a soft landing when inflation cools without causing a recession. A hard landing or rough landing is when a recession follows high inflation. Since Trump took office, markets overall are actually down. Early in his term, stocks and Bitcoin soared on optimism. But now the reality of trade wars and tighter policy is sinking in. If the Fed raises rates too much, it can tip the economy into recession. If it holds rates too high for too long, that also risks a downturn. Finding the right balance is hard. Remember that only about half of Americans own stocks. When the market tumbles, those without investments don't feel it directly, but they do feel higher prices at the grocery store or the gas pump. Tariffs raise the cost of imported goods and companies pass those costs on to consumers. That can push inflation higher, which then forces the Fed to raise rates more. It's a cycle that can end badly if it spins out of control. If you're retired or close to it, now's the time to review your risk. Big market drops can erase years of savings, so think about shifting some money into safer options like bonds, cash, or CDs. Keep an eye on how recession gets defined. Minor GDP dips may be called full recessions under different leaders. A technical recession is a quick, short-lived dip that usually rebounds fast, whereas a structural recession is deeper and longer. Trump has shown he'll tolerate market drops to pressure trading partners into fairer deals, preferring tariffs on steel, autos, and IP over taxing Americans. He uses the same unpredictability in foreign policy, pointing to 2020 Iran sanctions as proof they work. Over the weekend, Mexico's president reassured investors that USMCA already zeroes many tariffs, likely exempting Mexico from any new reciprocal duties before markets open Monday. Trump cast himself as Tariff Superman, saying U.S. defense spending shields Canada and Mexico, so they should help pay through tariffs. He's willing to accept higher prices and market drops now to secure tougher trade deals. Though it may hurt short-term, he believes it will strengthen manufacturing, rebalance trade, and raise wages in the long run. Investors must choose whether to stay the course or seek safer assets.